The reality of a weaker economy in which lower growth slowed down virtually every major sector is now being captured by the Uganda Revenue Authority, whose shortfall in collection for the ended financial year 2016-2017 hit nearly £500 billion.
One of those figures that I would like to point out is petroleum revenue. We had a significant drop in the amount of growth of volume in petroleum. So the 388.1 billion, a lot of it is accounted for by the significant drop in growth of petroleum import revenues.
And perpetual challenges of small and medium enterprises apart, the larger taxpayers absorbed the pressures within the economy that interfered with their compliance on corporation tax, among others.
Services, information and communication, which is basically telecoms, manufacturing sector, then wholesale, retail, and then construction sector. So if you have 3 of the 5 underperforming, you will have a lower than expected profitability and this affects the corporation tax. So of the 457.51 billion, 388 is coming from customs, 197.15 is coming from domestic taxes and specifically relating to corporation tax.
By way of outlook, the Uganda Revenue Authority remains concerned that the tax measures unveiled in the current financial year 2017-2018 are instead revenue reducing, projecting further challenges on its new 15 trillion shilling target.
But now we've had revenue reducing measures. So when you have a target on the back of revenue reducing policy measures, that's why I say it's a stretch target, because it will stretch us to look for revenue in other areas where we would not otherwise expect revenue to come from as a result of policy.
Among others, VAT waiver on selected items, corporation tax waiver for some entities, income tax for SACCOs were exempted in the current financial year, worth billions of shillings combined. Raina Ojon, NTV Business.